Hey everyone, and welcome to this explainer. If you're a finance pro working in the Middle East, you already know the month-end close can literally cause sleepless nights. Today, we're demystifying exactly why the Kingdom of Saudi Arabia's month-end closing process is so unique. If you're ready for some structured, actionable info, let's dive into the source material together. Now, you might be wondering, is my standard global month-end close enough for KSA? Look, you might have a bulletproof process that runs flawlessly in New York, London, or Tokyo, but is that standard enough here? The short answer is a definitive no. Applying a generic global template is a one-way ticket to the trap of non-compliance. Okay, let's dive into this. Because understanding the specific non-negotiable mandates of the Saudi market isn't just about good bookkeeping, it's about business survival. So here's our roadmap for today. 1. The KSA month-end close. 2. Phase 1, reconciling accounts. 3. Phase 2, assets and liabilities. 4. Phase 3, report and review. And finally, 5. Essential KSA compliance pillars. Section 1, the KSA month-end close, a high-stakes journey. And this brilliantly illustrates exactly what we're looking at from a bird's-eye view. We've got our 3 chronological day-to-day operational phases right at the top. But actually, notice what sits beneath them. They're resting directly on a very strict KSA regulatory snapshot and foundational compliance pillars. Basically, every single step you take up top is heavily governed by those absolute rules anchored at the bottom. Moving right along. Section 2. Phase 1. Reconciling accounts. The operations base. Now, these steps are going to look super familiar if you've got an accounting background. Step 1, reconcile your bank and cash. Step 2, match your accounts receivable and payable. Step 3, get out there and perform those physical inventory stock counts. Yep, time to dust off the clipboards. You have to anchor your financials to reality. But here's the thing. While the actions are universal in Saudi Arabia, the context around them is incredibly strict. And here's the twist. While you're reconciling standard AP and AR, you are constantly bumping up against ZATCA. ZATCA represents a strict regulatory mandate enforcing e-invoicing compliance right there in Phase 1, and it carries over into Phase 2. So you aren't just matching invoices to purchase orders, you're verifying that every single transaction complies with real-time electronic invoicing mandates dictated by the government. The standard step? Yeah, it's got a massive local regulatory hook. Let's move to and see how this builds in Section 3. Phase 2, assets and liabilities, the local twist. All right, into Phase 2, we have 3 crucial steps. First up, record depreciation. Second, post accrued expenses. Sounds standard enough, right? But then we hit Step 3, verify payroll. And notice the massive caveat attached here. This verification must specifically include GOSI and Zakat. This isn't just about making sure your employees' direct deposits go through. It's a make or break regulatory checkpoint. Let's break those terms down, starting with GOSI. As outlined in our source checklist, GOSI is a distinct requirement that must be specifically included and verified during the payroll phase. It stands for the General Organization for Social Insurance. Look, it's an immovable local checkpoint. If your payroll verification doesn't meticulously account for these mandatory social insurance contributions, well, your Phase 2 is incomplete and your compliance is basically compromised. Alongside GOSI, payroll verification also has to factor in Zakat. Zakat is a mandatory Islamic wealth tax and a fundamental KSA compliance element. What's super fascinating here is how the source material links Zakat to multiple parts of the close. You verify it here in Phase 2 during operations, but it also ties directly into those overarching tax filings we'll cover in a second. It's like a thread woven through the entire Saudi financial ecosystem. Okay, bringing us to Section 4, Phase 3, report and review, the final check. So at this stage, all that reconciliation and those local adjustments culminate into 2 distinct steps. Step 1, prepare your financial statements. Step 2, conduct management reviews of variances against the budget. And because you've already baked in those strict local requirements, like ZATCA e-invoicing and GOSI, your management team can look at these budget variances knowing for sure they reflect the true, compliant, operational reality of the business in the KSA market. And finally, Section 5, Essential KSA Compliance Pillars, the regulatory foundation. Now, what's really interesting about this slide is how it defines the actual rulebook you're playing by. You can't just present your Phase 3 statements however you feel like it. You absolutely must adhere to SOCPA and IFRS standards. SOCPA, the Saudi Organization for Chartered and Professional Accountants, dictates the standardized local reporting frameworks that you must follow where applicable, and they align heavily with IFRS. This is exactly what guarantees uniformity and transparency across the kingdom. And hey, if you think standardizing the framework is rigid, just look at the currency and language rules. A standard global close might let you get away with dual currency reporting or English-only ledgers depending on your HQ. But the KSA regulatory snapshot explicitly demands maintaining all essential documents in SAR, Saudi Reals, and in Arabic. Literally no exceptions. It's a strict, non-negotiable localization of your financial data. Quick Google Translate solutions are definitely not going to cut it here.
All right, I really want to draw your attention to this number right here, 15. In the context of KSA compliance, the 15th of the month is a deadline you absolutely cannot miss, ever. This represents the strict ZATCA mandate to submit your VAT returns. All that Phase 1 and 2 compliance with e-invoicing, it all leads right up to this single critical day. Miss the 15th and you are instantly facing regulatory scrutiny and some heavy penalties. It really adds a jolt of urgency to the whole month-end sprint, doesn't it?
To actually hit those strict deadlines and standards, finance teams rely heavily on a solid third pillar: accurate adjusting entries. The source highlights a rapid-fire list of the most common ones you really need to master. You've got to account for doubtful debts, carefully manage your insurance prepayments, and absolutely ensure accurate revenue recognition cutoffs. Think of these adjustments as the fine-tuning that keeps this entire compliance engine running smoothly.
Ultimately, all of this preparation points toward one absolute necessity. So the crucial point is this: you must ensure your tax filings are on time. Specifically, as noted in the KSA regulatory snapshot, we're talking about your withholding tax and your Zakat filings. Honestly, if you've executed the 3 phases perfectly, but failed to file these specific taxes accurately and on time, well, the entire close process has basically failed its primary regulatory objective.
Wow, we've covered a tremendous amount of ground today, right? From the operational base of Phase 1 all the way down to the deep regulatory pillars holding up the entire Saudi financial system. I want to leave you with one provocative thought to take back to your teams. Look closely at your own systems and ask yourself, does your current compliance stack genuinely meet SOCPA, IFRS, and ZATCA standards? Thanks so much for joining me for this explainer, and I really hope this helps you master your next month-end close.